Let's start with mastering correction of accounting errors. We have several types of accounting errors that can occur, most of which you've seen in a previous accounting class. Omission is an event that was never recorded. Accrual or deferral error is where we had no adjusting entry that was recorded or was recorded for the wrong amount. Classification error is an amount was posted to the wrong account within a category. For example, the bill for rent was posted to insurance expense. Arithmetic error or an arithmetic error, you have incorrect addition, multiplication, or something else involving math. Use of an incorrect accounting principle, an example would be that revenue is recognized before it was earned. Use of an improper estimate, well, if we take a look at depreciation expense, the depreciation was computed using the wrong useful life. So a piece of asset, equipment, should have had a 5-year life, and we computed it using a 4-year life. Transposition error, 2 digits were reversed. For example, 739 was recorded as 379. You have the digits 7 and 3 transposed. A slide error, the decimal point was put in the wrong place. For example, 1,000 should be 100. Posting error, an account was credited when it should have been debited, or debited when it should have been credited. Accounting errors are usually discovered during the monthly bank reconciliation, preparation of a trial balance, reviews of end-of-period adjustments, routine or internal audits, year-end audits by external auditors. The bank reconciliation, well, we need to take a look at it because cash is the lifeblood of a business. Even a profitable company, one that has had a net income each month, month after month, period after period, year after year, can fail without adequate cash management. Cash is an asset that can be easily hidden or moved, and it makes it an attractive target for theft. So we need to have internal controls on cash. They're very critical for every business. Bank reconciliation is probably the most important control that we can have in regard to cash. So we need to prepare a monthly bank reconciliation statement. Now, keep in mind, the bank reconciliation will account for differences between balance per the bank statement and balance per the company's general ledger cash account or cash accounts. We need to be sure that the bank reconciliation is prepared by an employee who does not have custody of nor keeps the records of the cash. The cash account balance and bank statement balance often differ. There are items on the company's books that are not on the current bank statement. There will be outstanding checks that were written but have not cleared the bank, deposits in transit, company bank deposits that are not yet appearing on the bank's books. And then there are book errors that occur. Items on the current bank statement that are not yet on the company's books, bank service charges. These are recent bank fees and other charges. Collections of notes where customer loans have been repaid with interest directly to the bank and recorded in our bank account. Non-sufficient funds checks or insufficient funds or bounce checks. These are customer checks that we deposited but have been returned because they did not have funds. And then there are bank errors that can occur. So looking at an example of the format, here we have XYZ Corporation, Bank Reconciliation August 2009. We're going to start, we've got two halves to this. We've got a half side that is per the books and another half side per the bank. Now I'm used to seeing these reversed to where the bank would be on the left or on the top and the books would be on the right or the bottom. But it's okay. This will work. And then they have the corrected bank balance at the end of the month, or adjusted bank book balance. And this is what will show up on the balance sheet as our cash balance at the end of the month. So we need to reconcile on the books. We need items on the bank statement that we have not yet recorded by the company. And for the bank, we need to reconcile items that are on the company's books that are not on the current bank statements. Our objective here is that we need to, at the bottom, have a matching balance. So when we go through this, the balance for the books, we're going to add to the book balance notes that have been collected by the bank. So the collection of the principal amount plus interest will be added, and we'll deduct those non-sufficient funds checks and those bank service charges. On the bank side, we need to add deposits in transit, also known as outstanding deposits, and we'll deduct outstanding checks. Let's look at an example for Jimbo. As of 11/30, Jimbo's ledger cash account balance is $16,150, and its bank statement balance is $33,520. Two checks totaling $9,810 are outstanding. Okay, that is something that we need to take a look, and it goes on the bank side for reconciliation because the bank is unaware of this. Then we have a night deposit of $12,150 from the 30th is not on the current bank statement, so that too goes on the bank side. The bank charged Jimbo's account for a check written by another company for $160 on the bank side. The bank statement shows collection of a $20,000 note receivable plus $900 interest. That's something that we'll be adding to the books balance. And then the bank statement shows an NSF check for $1,000 and a bank service charge for the check of $30. That goes on the books to be deducted. So now we're going to look at this. There's a 3-line heading, Jimbo Bank Reconciliation, November, should be November 2009. This will be giving us the adjusted or corrected bank balance for November 30th. So on the balance for the books side, we're going to add the collection of the note, the principal plus interest. We're going to deduct the NSF check of $1,000 and the bank service charge of $30. On the bank side, we'll add the deposits in transit and subtract the outstanding checks. And when there's a bank error there of $160 that needs to be added, and then we have $36,020 that is our corrected book and bank balance, so we have a match. We can double rule. Now, the book items to be reconciled require that we make journal entries, because if you recall, look up there, we have a balance for the books in our general ledger cash and bank account of $16,150. So we need to make these adjustments, the journal entry adjustments, so that we'll wind up with a $36,020 balance. So the additions, we need to debit to cash $20,900, credit notes receivable of $20,000, and interest receivable is credited for $900. We debit accounts receivable for the non-sufficient funds check of $1,000 and credit cash. We're going to continue to try to collect from our customer the $1,000. We have a miscellaneous expense debit of $30 for the bank service charge expense and a credit to cash. Some accountants may have a bank service charge expense account to use and set up for this, but they've opted to use miscellaneous expense. All right. Now, to find the errors in the unadjusted trial balance, we need to follow these steps. First of all, you need to check that all account balances have been correctly transferred to the trial balance. And you need to scan the account balances to see if they have, if they're in the correct column. You look for normal balances. Your assets should have a normal debit balance unless they're a contra asset account, like accumulated depreciation. Your liabilities should have a normal credit balance, so scan all of those. Make sure that every account with a balance was transferred to the trial balance. I like to count how many balances, how many accounts I have, and then I check it before I transfer and after. Verify that the balance listed in the debit or credit column matches the one in the account. Here's an example. We have, and these are listed in orders, in the order of assets, liability, owner's equity, revenue, expenses. And as you scan these, take note. Do all the assets have a debit balance? Do all the liabilities have a credit balance? Revenue a credit balance? All cost of goods sold and all the expenses? I'm seeing one here that isn't incorrect. They've pinpointed that accounts payable, the liability account, should have a normal credit balance. Now, the next step is to total the debits and credits. If the totals do not equal, we're going to take these steps. We're going to check for a doubling error. So we're going to look at the example again here. We already identified accounts payables in the incorrect place, but they're going to total. So we total. You've got 6,225 for the total for debits, 4,821 for the total for credits. Find the difference, which is 1,404. Divide by 2, it's 702. We can pinpoint that. That is the accounts payable. It's showing as a debit. It needs to be a credit because that 702, by debiting it when it should be credited, has caused it to be twice the amount. So we correct. After correction, re-add. We now have a match. The totals are equal. We need to check for a slide or transposition error. So we're looking at this. You're scanning it. We're way out of balance. The debit total is much greater than the credit balance. Find the difference. To check for a transposition or a slide, you divide by 9. If it divides evenly with no remainder, no decimal numeral, it's 799 in this case. That's indicative that it could be a transposition or a slide. If you take a look at accounts receivable, that's one that number is considerably greater than the others. So we've got it. It's got an extra 0. There, we're going to make that 799. Re-add. Now they're equal. So that was a slide. Here's a transposition. Transposition error occurs when 2 digits have been reversed. We have some examples here, like 123 is recorded as 213, 7912 recorded as 9712, and so forth. If you're looking at that, so we want to again take our totals, take and subtract. If it's divisible by 9, besides being a slide, it could be a transposition. This one divides evenly, 20, there is no remainder. So we want to see, to find the amount that has been transposed. Find the difference between total debits and total credits and add 1 to the first digit. Example, you find a difference between the totals of 180. The first digit is 1. Add 1 and you get 2. Find the account balances with that difference between the first and second digits. Look for the account balances where the difference between the first and the second digits is 2. So we're looking through that where the difference between the first 2 digits is 2. Scan through and see if you can locate Okay, because here we've got 180 is the difference. So we've added 1. We're looking at 2. Let's see what we've got. Looking for the difference. The only one that fits that is the cash amount of $757, because the difference between the first 2 digits of 7 and 5 is 2. So it needs to be, and we'd go back and check and verify this by looking at the general ledger account. It's 577. We want to do a re-add. That makes them the equal. Okay, we're in good shape. You need to also examine the journal entries and the postings. Verify that the journal entries were posted correctly to the ledger accounts. Review the journal entries for obvious errors. You may need to examine source documents.